Welcome to our new series, Envisioning India. I'm James Foster, the director of the Institute for International Economic Policy, or IIEP as we call it, at the George Washington University in Washington, D.C. I'm also the moderator of today's conversation with Viral Acharya of the Stern School of Business in NYU, who will present Fiscal Dominance, a theory of everything in India. Thank you, Viral, for joining us today. We are also honored to have two remarkable discussants to respond to his presentation. First, Pulitzer Prize-winning author Liaquat Ahamed, who I'm told spent some quality time across the street from GW at the World Bank, and Rakesh Mohan, who, when he last visited us at GW, was Executive Director for India at the IMF. Thanks to Ajay Chhibber, who's a distinguished scholar with us at IIEP, for organizing the series. Ajay will provide formal instructions in just a second. But first, a word of thanks to our co-sponsor, the Seeger Center for Asian Studies, which is right next door at the Elliott School, and whose director, Ben Hopkins, is a South Asianist and a great supporter. Now, for those of you who haven't attended a previous IIEP event, either at the Elliott School or online, you can expect a nonpartisan, lively, and informative conversation on such topics as US-China economic relations, urbanization and poverty, global economic governance, climate change, green finance, and digital trade. Our last event featured Kaushik Basu of Cornell University discussing his newest work, which examined morality from a game theoretic perspective. Our next Envisioning India episode will feature Raghuram Rajan and Beena Agarwal discussing the pandemic in India. Join us October 15th for our second event in this series. Tomorrow, IIEP affiliate Susan Aronson, who's head of our digital hub, will lead a panel discussion how 3D printing might affect trade and trade rules. And this year, our 13th annual conference on US-China economic relations will become a serial conference, nicely complementing our India series with an episode each month. Finally, be on the lookout for our Facing Inequality series, whose last episode brought Georgetown political scientist Nita Rudra across town to tell us how informal workers in India view international trade. If you can't make an event synchronously, videos can be found on our YouTube channel at IIEPGW. Now, allow me to turn the floor over to Ajay Chhibber. Ajay? Be sure to unmute.
Thank you, James, for that introduction. And we are in for a treat today for the first virtual event series, a virtual event for the India Envisioning series. We have three very distinguished speakers. We have, of course, Professor Viral Acharya. And as James has said, he's a professor at the NYU School. He was already very famous for the work he did on the global financial crisis, especially the work he did on Freddie Mac and Fannie Mae. And then he became even more famous as the deputy governor of the Reserve Bank of India, where he was a very strong and very vocal defender of Rbi Independence. He is also a cricket lover, and if you buy his book, which is, by the way, being offered on sale today by Sage, and if you wait through the end of it, you will find some very interesting cricketing analogies there. We also have two very, very distinguished discussants. Both started their careers at the World Bank, but then left quickly and went on to bigger and better things. We have Liaquat Ahamed, who is made a great career at Wall Street, but is best known for the Pulitzer Prize-winning book, Lords of Finance. Ben Bernanke, who's written probably the most on the Great Depression, said about the book that he wished that was the book he had written. So we have Liaquat, and then we have, of course, Dr. Rakesh Mohan, I consider him among the 4 or 5 top policy advisors that led to India's first wave of reforms, for which for 25 years, India held a growth rate of 7%. He has a book on that as well. He's also been Reserve Bank of India Deputy Governor, the position that Viral held well before him. He's also been Chief Economic Advisor and written a lot on banking, finance, and also is an expert on urban issues and infrastructure. So with that great lineup, let me over to you, Viral, for your presentation.
Thank you so much, Ajay and James, for the kind introduction. I must add here that I'm also very grateful to Liaquat and Rakesh. I couldn't have asked for any better discussion and consideration of the material in the book. Before I joined the Reserve Bank of India, I had actually had a very long conversation with Dr. Rakesh Mohan. And he told me that being a deputy governor is actually the best job at the central bank. I think I fully agree with him. I think it allows you to be in there and yet remain objective because you are not the governor and in the midst of it all while taking the final decisions. Normally, when I present the book, I tend to get straight into the crux of the preface chapter, which is titled Fiscal Dominance, a Theory of Everything in India. However, a lot of those talks have been in India, and because today the audience is somewhat more international, I'm going to also focus a little bit summarizing briefly how my term went, because that really lays the context for these theses of fiscal dominance. So without much ado, let me start. I left New York for Mumbai on the evening of 21st January 2017. As I sat at Newark Airport awaiting to board a United Airlines flight, I couldn't help reflect on the fact that the Indian banking sector was sitting on one of the highest non-performing loans to assets ratio among the G20 countries and actually even among the group of emerging markets. This was a marked departure since its standing in 2009. The poor capitalization of Indian banks from an economic standpoint had been evident in the stock market data at least since 2013. Indian public sector banks stood out as having particularly weak balance sheets in terms of their ability to withstand further stress, something that we had been seeing in a measure of systemic risk that we produced at NYU Stern School of Business since the global financial crisis. It was obvious to most that financial stability of the banking sector and economic growth in India were at risk. At that time, we had just had the demonetization decision of November 2016, and there was ambiguity about its exact impact on the real economy and the financial sector. Now, banking sector stress in India tends to play out somewhat silently, just as in China, where state-owned banks hold the majority of deposits and loans. This is because, unlike many other parts of the world, India has government ownership in a significant way of the banks. And this government ownership rules out that depositors run en masse on public sector banks, even if the borrowers of these banks have defaulted en masse. Now, some consider this inertia of the depositors as a positive backdrop for financial stability. But of course, this is true only unless and until the sovereign balance sheet solvency is itself considered to be on the brink. Nevertheless, undercapitalization of public sector banks, combined with the lack of significant market discipline and possible behest lending, leads to a serious misallocation of credit. Most commonly, this takes the form of evergreening or what is called as zombie lending, lending to the walking dead. Effectively, there is extend and pretend of the loans of severely distressed or even defaulted borrowers. And this is an effort to not recognize the erosion of bank capital. Usually, this form of an outcome, zombie lending, evergreening, extend and pretend, kicking the can down the road, whatever one calls it, usually this is a phenomenon that is supported by explicit or implicit regulatory forbearance, wherein the banking regulator turns a blind eye to the state of affairs. Undercapitalized public sector banks, even if they don't experience deposit runs, are thus a significant cost to the healthier parts of the real economy, even if these banks never witness the runs, as I emphasize. Such a silent crisis, a slow run, had been playing out in the Indian banking sector since at least 5 years, given the boom and bust of credit-driven fiscal stimulus post the global financial crisis of 2008. The thought that crossed my mind was, could a push be made to address this unfortunate state of affairs and in a decisive manner? As I boarded the flight, I felt energized that if there were to be a meeting of minds on these issues with the Reserve Bank of India, and fortunately that turned out to be the case, then I could help hit the ground running as soon as I reached Mint Street. That's where Reserve Bank of India physically is in Mumbai. I promptly sat down to make a checklist manifesto, just like a grocery list, and it was titled Restoring Financial Stability in India. I put down the critical steps that I thought we must undertake so that economic growth could in future be smooth sailing rather than a bumpy ride. My list was short. It comprised 2 bullet points as follows. First, fix the health of the banking sector, especially that of public sector banks, with reforms such as consideration for a change of ownership, recapitalization, prompt corrective action for undercapitalized banks that had a repeated track record of poor underwriting standards, timely recognition of losses, and importantly for the real economy, a decisive resolution of stressed assets. So that was the point 1 of the grocery list. The second point was to develop financial markets to improve the efficiency of capital allocation, reducing the dependence of the system on bank credit and allowing market-based mechanisms to reward and punish the borrowers and the financial sector for whatever their outcomes be. Now, it's only been slightly over a year since my term ended. I quit 6 months early. So at the risk of judging too soon, I provide an assessment of our, as in the Reserve Bank of India's performance on both fronts. On the first issue, which was closer to the banking sector resolution, we achieved moderate success in terms of fixing the health of the banking sector. In fact, within a year since I had joined, considerable progress had been made in restoring financial stability in India. Some of the early speeches which are covered in the book, especially in part 1, they relate to some of this progress that was made. The asset quality review initiated in 2014-15 had reached its conclusion. This had allowed a marking of bank assets more accurately for the losses that had been incurred on the legacy loan portfolio from the fiscal stimulus, as I mentioned. The government of India had announced a significant recapitalization package for public sector banks, with a noted departure that the plan was to reward healthier banks with growth capital for a change, and weaker public sector banks were put under the prompt corrective action framework, which was tightened to get closer to the framework in the United States. The idea being to prevent the weaker banks from raking up even further losses and bleeding taxpayer money. And most significantly, the resolution of large non-performing bank assets was put on a fast track on the back of the recently implemented Insolvency and Bankruptcy Code, which I still consider one of the most important structural reforms of the last 5 years in India. At times, it seemed to me, even if in hindsight that was just wishful thinking, that a reprivatization of a few public sector banks might also be on the table. Now, this was terrific progress in little less than 10 months from my standpoint. Everything was on track. Markets, rating agencies, and multilateral institutions recognized the potential of these structural reforms for financial stability as boding well for India's long-term growth and sovereign credit rating. Yet, in exactly about 10 months that followed, not only did progress stall, but also several policies regressed. Capital was injected in weaker rather than healthier public sector banks. Not much market capital was raised by any of these banks as was originally envisaged. Capital standards and prompt corrective action framework were diluted. Forbearance, as in kicking the can down the road for recognition of loan losses, crept in again for some asset classes. And perhaps worst, the resolution of several non-performing borrowers under the Insolvency and Bankruptcy Code was stayed by the judiciary. The central bank came under intense pressure to open up what I refer to as liquidity and credit taps to prop up the economy, pressures that had to be and were resisted and reasoned against, as I'll explain. In the end, even as some compromises were reluctantly struck, the ambition and institutional anchoring of our early steps in 2017, which were focused on putting in place these pillars for financial stability for the next 10, 20, 30 years, in my opinion, they helped save the day. While there was a marked attrition in outcomes relative to our original objectives, a complete degeneration into excessive monetary and credit stimulus that had just caused the Indian financial sector to lose its stability in the previous decade, that sort of excess had been rendered difficult. However, there were attempts to alter the governance structure of the Reserve Bank of India to institutionalize such outcomes in future. This would have meant crossing the Rubicon and had to be foiled. And as a result, some of us gave way in the end in order to raise a public debate about these issues. Now, on the second issue of developing and unleashing the allocative power of capital markets, we were more successful. But my one continuing lament here is that the play in the Indian government bond markets and what I refer to as the media and analyst chorus or cacophony, perhaps, that goes with it, is gradually evolving into just bets on the extent of the central bank's market interventions. It creates a vicious trap of meeting ever-rising expectations of the markets. Unfortunately, this is something that the Reserve Bank hasn't been unshackled from, and it has become a crutch that the Indian bond markets haven't learned to walk without. The result is that the central bank's liquidity, perhaps even interest rate policy, are affected in a significant measure, and they affect, as well as being affected by prices in the government bond market, and in turn the cost of financing the government bond. Now, these 2 points, the regression of the efforts on bank resolution and this continuing lament I have of overindulgence or over-interference of the central bank in the bond markets, these are interlinked and provide a natural segue into the main point that I make in the very extensive preface chapter of the book. So To summarize, when I reflected on my experience, there were some questions that kept bothering me. They had kept me up at nights during my term as well, but I had not had the benefit of distancing myself and having a common diagnosis of what was going on. And these questions were, why are efforts at restoring financial stability seen as contradictory to pursuing growth, even though all evidence now, especially in the last 3 to 4 decades, points to financial stability being a necessary condition for long-term growth? We had the global financial crisis, but as I have been noting in my research all along, in the 30, 40 years prior to that, there were systemic banking crises in different parts of the world at different points of time. It's just that the developed countries had not had a full-fledged banking crisis, perhaps with the exception of Japan and Scandinavia. Why does the central bank, when it seeks to implement financial stability reforms fully and sustainably, always face an uphill battle with the entire system? Is there some common undercurrent of resistance which makes it hard to achieve consensus on long-term structural reforms of the financial sector, even when they make much common sense? Specifically to India, does the pursuit of growth focus mostly on credit-based stimulus in the short run? And is this what causes efforts to restore financial stability to routinely stall? And on the second point, what is it that's preventing the central bank from letting it go as far as price setting in government bond markets is concerned, even though India is moving towards becoming a market-based economy? Now, on each of these questions and the account I provided, you can identify detailed specific triggers. But to me, what was important was that there emerged a uniform answer in my mind to all these questions. And I refer to that as fiscal dominance, which I will position as a theory of everything in India, even if that's at the cost of some exaggeration. So what is fiscal dominance? In macroeconomics, this was a concept introduced by Neil Wallace and Thomas Sargent, traditionally defined as a state of the country in which large government debt and deficit as in spending of the government over and above its revenues, prevent the monetary policy authority from meeting its mandated economic targets such as inflation, growth, and employment. Instead, the central bank is kept primarily focused on ensuring that the government can roll over its debt and deficit, and in particular, that the government does not default on its liabilities. The concerns may not be as much of a cliff risk. There could be interim rating downgrades along the way that could become a minor cliff point rather than just a sovereign default. So what happens under fiscal dominance is that the central bank becomes willing to accept excessively low levels of interest rates and high levels of monetization, simply printing a lot of money and handing it out cheap in exchange for government bonds. And the central bank does so even if inflation is or risks being pushed beyond reasonable thresholds. The central bank does so because it is no longer focused on inflation, but it is focused on aiding the government's borrowing programs. While this has not been explicitly said yet, this is my assessment of the central banks in developed economies also having gone into the foray of quantitative easing, unconventional monetary policy, etc., at least in some countries, if not all. Nevertheless, let me focus on India today. Now, a state in which fiscal dominance arises is often considered undesirable for the country, as large-sized government debt and deficit tend to be driven by short-term populist pressures, not always, but in many cases, whereas the central bank is mandated to achieve long-term stable objectives for the economy and the financial sector. So fiscal dominance of the central bank can be adverse on at least two counts. First, it prevents the central bank and thereby the economy from achieving its long-run stability goals. And second, and this is a nuance that I have added throughout the book. In fact, my most noted speech as a deputy governor was the A.D. Shroff Memorial Lecture pushing for the independence of the central bank. And therein, the view I expressed is that the central bank should be seen as an independent regulatory institution, not an arm of the government, but an independent institution that serves a useful checks and balances role for the government's excessive borrowing and spending programs. In fact, in my own mind, a central bank should be put on the same pedestal as an election commission or the judiciary or the courts that enforce contracts and so on. Now, under fiscal dominance, instead of the central bank playing this useful checks and balances role, it ends up facilitating the short-term tendencies of the government because it's getting fiscally dominated. Now, what's my contribution in the preface chapter from an intellectual standpoint? It is that in a country like India, the central bank is an all-purpose central bank. It is in charge of banking supervision and regulation. And while the traditional view of fiscal dominance is limited to monetary policy, in case of a country such as India, and I think this applies especially to emerging markets, but as I said, increasingly even to developed countries, there is the risk that fiscal dominance stretches into bank supervision and regulatory outcomes. And now you get a compromise of financial stability, not just of the monetary policy objectives such as price or inflation stability. Now, I won't dwell into too much detail, but India is actually a very likely candidate for the prevalence of fiscal dominance. India has a very high government fiscal deficit, presently at the top 2 in the G20 nations. It has had so for a long time. India also runs a current account deficit and by and large also has a negative balance of payments. So the combination of the fiscal deficit and current account deficit always have to be managed so that the external sector remains stable. And these twin deficits can combine both with domestic problems. So when there is either a supply push inflation from the government, as is often the case in build-up to an election, or if there are external triggers such as the Federal Reserve rate hike or significant dollar absorption in its policy, they tend to create of a storm in a teacup every few years. And occasionally, I would say once in a decade, maybe a more serious external sector problem. Now, one way, and there is always questions asked about the fiscal deficits at that point of time, and naturally so, because a lot of the flows from the outside the country are into government bonds. Now, one way that the government can try to address its problems of large debt and deficit is to undertake tough structural adjustments in their level and composition. I don't mean for the government to do this pro-cyclically, so not in the midst of a crisis, but at least over a stretch of time, starting the work in normal times or calm times. But instead, if the government's horizons are very short term each year because some election is coming up, or it simply doesn't want to do the hard work of selling the structural reforms to the economy, then it can do what is more expedient, which is to economically and financially repress the economy to fund its borrowings. Now, in India, the reason why such fiscal dominance has the potential to affect virtually all financial sector policies and regulations is because there are important conflating factors. And I thank Dr. Rakesh Mohan for helping me understand these conflating factors with much greater clarity than I could have on my own. And the key to understanding the present Indian context is to pay some attention to its history. even today, there are strong remnants of the pre-1990 era of centralized economic structure and control in India. And its implications are the following. On the one hand, there is an overarching presence of the government in public sector banks, other large state-owned financial institutions such as the Life Insurance Corporation of India, and state-owned enterprises such as Power Finance Corporation, which is effectively like a bank that takes care of power sector bad loans. Now, the government, because of this imprint in the financial sector, always has an incentive to dominate the central bank and financial sector policies to affect the outcomes for the state-owned entities and its own borrowing programs. In fact, sometimes there is incentive even to intervene in the stock market to skew the signals that are coming out of there. The net outcome of all this is that market terms in India are always distorted for the private sector to borrow or to raise equity. And more importantly, it distracts regulators such as the central bank from the long-term policy goals. There is another perverse effect of all this, and this is a slightly Austrian or a Hayekian view of the world, which is that once the government begins to influence policies, control the markets, does not allow right signals to come about, and especially crowds out the private sector, it also ends up crowding out their enterprise. The private sector instead engages more in rent extraction rather than value creation, looking to always engage in hyperactive lobbying or consultations with the government and the regulators, because the game in town becomes one of designing policies that will be friendly to the incumbents rather than allowing creative destruction, reallocation of distressed assets, ease of doing business, and facilitating entry of new players. Now, India has made progress, as Ajay and James mentioned, especially in the 25 years from early 1990s reforms. The progressive steps that were undertaken then to limit fiscal dominance were undertaken in an economic environment of consolidating government debt and fiscal deficit trajectories, high economic growth, and rise in household financial savings. However, fiscal dominance has once again taken hold of the Indian economy as these conducive factors have gradually reversed. In particular, the government deficits have been slipping in a real economic sense, even though official statistics have been made to look all right through all kinds of jugglery. Economic growth has slowed. In my view, it is not just a matter of coincidence that growth has slowed and the deficits have risen. The two are actually intimately tied with each other with a back and forth causal relationship. And household financial savings have collapsed as well, something that's very important to understand going forward for the Indian economy. Now, the reason why fiscal dominance affects India's financial stability, and I'll just quickly mention the high points. It affects bank recapitalization and regulation because bank assets are never marked properly. Second, even borrower defaults are never disclosed in a timely manner to anyone, including rating agencies, because that would mean a re-rating of the borrowers and a greater recap bill for the government on public sector bank balance sheets. There's constant pressure to err in monetary policy by making inflation errors in one direction so that interest rates can be kept low. There's a desire to engage in constant open market operations to purchase government bonds. And in fact, that is the only discussion you will see primarily of Indian bond markets in newspapers from analysts and from the market players. When is the central bank doing the next round of open market purchases? I think India has been in a quantitative easing mode over the last several years, regardless of whether it's a crisis or whether it's not a crisis moment. Fourth, market regulations are often skewed. Recognition of bond losses by banks is postponed on an ongoing basis. And all of this ends up relaxing the discipline that the markets should have on the government borrowing programs. And I also explain how capital flow measures and central bank balance sheet distribution in the form of dividends from the central bank to the government also come routinely under pressure. Unlike the traditional notion of fiscal dominance, I explain 6 ways in which fiscal dominance can have adverse impact. Firstly, as I mentioned, there's the crowding out of the private sector, especially of the micro, small, and medium-sized enterprises. Their borrowing costs are very high because the government saves all the savings of the economy for its own borrowing. So, there's a real quantity crowding out of private borrowers. Second, because the private sector can't borrow domestically that easily, they are forced to borrow externally, and that has its own share of external sector fragility issues. Third, because the government borrowing tends to be at the longer term, the private sector is forced to borrow short term, even though that entails rollover risks. This is another form of crowding out that I explain in detail in the last chapter of the book. And there is very poor transmission of monetary policy to the real economy because the primary transmission happens to the government bond market. Everything else is determined by the quantity constraints imposed by the government. Now, beyond these, there are 2 other important side effects. One is that fiscal dominance can lead to crises, because I described that both the fiscal stability and financial stability in India are like a stretched rubber band that's waiting to snap the moment there is a little bit of extra pressure applied, and you don't know actually what that tipping point is going to be, just like the rubber band that I broke last night while trying to close the dinner box. And also it leads to a low productivity trap because of this second perverse effect that the private sector no longer sees value creation as its or productivity as its gains to prosperity. Instead, it focuses on compromising the central bank regulations and other financial sector regulations so that it can be the one in place rather than the new entrants. I end the chapter with presenting what needs to be done on the fiscal and the financial stability fronts. Maybe I can take that up in the questions. I'm sure both Liaquat and Rakesh will have a lot to say about some of the measures I propose. But let me end by just making 3 points. When I think about what India should do to fight fiscal dominance, I think about the late Governor Paul Walker of the Reserve Bank of India and his obduracy with the Reagan administration. As you might all know, Paul Walker had just arrested double-digit inflation in the United States when President Ronald Reagan came to office. He had an expansionary manifesto, and there were pressures, as is now documented in at least 2 books on Paul Walker. He nevertheless resisted the pressures and refused to let the inflation focus go away. And in the end, he was able to resist the pressures. He was able to not cut the rates. And in fact, the fiscal situation in the United States normalized from what had become a steepening yield curve in response to the expectations of fiscal expansion. So he stood his ground right from the beginning, and in the end was able to resist the pressures. Interestingly, very recently in a panel I participated in, Paul Tucker, former deputy governor at the Bank of England, observed that he's waiting for a Paul Walker moment in financial stability in the global economy. Second, I want to quote Janet Yellen, who was also a deputy governor at the Federal Reserve in January 2019. I guess technically she was on the board of governors. She said that a clear lesson of history is that a sine qua non for sustained economic recovery following a financial crisis is a thoroughgoing repair of the financial system. And to me, there is an important message for India. India's approach to financial stability is evolving into one where it ends up leveraging yet another asset class to grow when the prior leverage boom has just gone bust and its mess has not yet been cleaned up. And this approach seems to be failing repeatedly because the next asset class then goes bust because it's just a short run credit push without actually strengthening the rest of the economy. In my view, an assessment, this approach has derailed Indian economy's long-term growth plans. There is no asset class now left to lever up, and the structural reforms are now critical. Unfortunately, the pandemic stress in the form of COVID-19 has struck, and financial instability clouds are gathering again over India's financial sector. In other words, we can no longer keep kicking the can down the road. Perhaps the right time to save for the rainy day is right now, whatever that moment be. Now, just because Ajay mentioned the cricket aspect, I will make that my third and last point. I always thought when I joined and when I was practicing as a central banker that I should play my role and take the same stance as that of the famous Indian cricketer Rahul Dravid. He was recently voted to be India's greatest test batsman. Because first and foremost, he always protected his wicket. He knew where his off stump is, which means you know which balls outside the wicket you have to leave and not try to touch. He always waited for the rank bad ball to hit a cover drive or to pull rather than swing for the fences on the first ball. His value as a batsman was most critical on tricky or treacherous wickets, like sometimes the swing conditions in England or the spin conditions in Indian or Pakistani wickets. And overall, if you watched him play, he always played the game of endurance, not of excitement, what I call in the book as the central bank trying to win a test match and not just a T20. So let me close there and hand it over to Liaquat and Rakesh.
Thank you. Yes, proceed, Liaquat.
Thank you, Viral. I enjoyed reading your book, and I enjoyed your presentation very much. When Ajay invited me to be a discussant in this webinar, initially I demurred. I told him I know nothing about the Indian financial system. But as I read more, I discovered that actually one doesn't have to know very much about Indian finance, let alone be a specialist in bank regulation, to know that all was not right in the Indian financial world. I mean, there have been periods over the past few years where every second day you couldn't open the FT without reading a story about some high-flying businessman absconding from India, leaving billions of dollars in unpaid bank loans behind. I think I read somewhere that there have been 40 high-profile fugitives, including the diamond merchant Nirav Modi and the flamboyant playboy Vijay Mallya, who've skipped the country, owing many billions of dollars. And at the same time, some of the most illustrious names in Indian banking, the chairman of Syndicate Bank or the head of ICICI, have been implicated in corruption scandals. So this was obviously a very fertile area for stories. And as Viral points out, India has faced an extraordinary financial crisis over the last decade, and he very appropriately calls it a silent crisis. The seeds of the crisis were sown during the debt fuel boom, when bank of the early 2000s, of the mid 2000s, when bank credit expanded an extraordinary 400%. That left a legacy of bank debts that are astoundingly high. A total from what I can tell, of $150 billion, which is roughly 8% of the $1.8 trillion in assets held by the financial system. And what is especially shocking is that the loan losses of public sector banks amounted to some 20% of their assets. To give you a standard of comparison, banks in the US during the 2008 financial crisis are estimated to have lost some $600 to $700 billion on assets of $12 trillion. So roughly 5% of their assets. In other words, India has faced the sort of hit to the capital of its banking system that the US did in the global financial crisis. Now, the crises aren't totally comparable. There was no bank panic or the sort of run on the financial system that we had in the US for the reasons that Viral points out, which is that for all intents and purposes, people view the liabilities of banks as essentially guaranteed by the government. But there was no doubt that this is a giant financial crisis. What I think is significant is from a political economy perspective, the losses have been dominated by some of the biggest business names in the country. And they've been highly concentrated in a few sectors: power, steel, construction, airlines, and most implausibly, diamond merchants. Now, as Viral points out, banking is a business where it's remarkably easy to disguise bad lending decisions. You simply make loans to zombie countries. In India, I think this was added to by, frankly, bribery and corruption. Lenders, the Indian industrialists, bribing Indian bankers to provide them with new loans, or using their political connections to put government pressure on the lenders to go easy on repayments. The interesting thing is that the bad debt problem was an open secret in Mumbai financial circles as early as 2011. It took more than 5 years for the RBI to acknowledge the problem. The dilemma with that is that the longer bad debts are allowed to fester, the more costly it becomes eventually to resolve the problem, because banks end up throwing good money after bad. Now, even though the RBI was slow off the mark to face the problem, the good news is that in 2015, it seems to have found religion and has introduced the RBI and the government introduced a series of reforms that force the banks to come clean about their problem loans. They agreed to inject more capital. The government agreed to inject more capital into the banks, and introduced new legislation like a new bankruptcy law to help them deal with their debtors. It was at this stage that Viral entered the picture. Although, for all I know, he may have been involved as an advisor before. He was recruited by the RBI to be adept of dealing with the burgeoning bad debt problem. And it's a tribute to him that he was willing to take on such a thankless job. Here's where the story becomes even more interesting. Even though the Modi government had signed on to a strategy of confronting the problem, it seems that it balked at the cost. Now, was that because it balked at the financial cost, or did it balk at the political cost? And that is one of the questions I have for Viral. he puts a lot of emphasis on the budgetary costs of dealing with the problem. I suspect there was a giant political cost of dealing with the problem, which caused the government to reverse itself. I wish actually I knew the full backstory. I mean, what we do know is that there was a period from 2016 until now where relations between the Modi government and the RBI have gone through a very rocky period. In 2016, the government failed to renew Raghuram Rajan as for a second term as governor, even though RBIs typically serve 2 terms. 2 years later, the next governor, Urjit Patel, quit before his term expired, and Viral quit, as he said, before the end of his term. When I look at this story, I can't resist paraphrasing Oscar Wilde's line from The Importance of Being Earnest, which is, he had a line, so the line goes, to lose one governor of the Reserve Bank, Mr. Modi, may be regarded as a misfortune. To lose 2 in a row looks like carelessness. And to lose a third deputy governor, well, ... There has been clearly a lot going on behind the scenes in the corridors of Indian financial power. And as a writer, I have to say that this has the makings of a great book. And in the right hands, it would make sort of a book like Andrew Ross Sorkin's Too Big to Fail. I mean, it has all the elements of a great financial thriller. Venal businessmen, lethargic bureaucrats, politicians manipulating things behind the scenes, a few idealistic crusader types from abroad like Viral, who try to shake up the system but are thwarted by powerful forces. If only we had been able to persuade Viral to tell us the full story, what a tale he would have to tell. He would, of course, have written a very different book from this one. Unfortunately, I think there seems to be a secret code among central bankers, which they sign on to when they enter the profession, which forces them to become models of discretion. And now I do not want to sound as if I'm criticizing Viral for not writing a tell-all book. All I'm suggesting is that someone should, or maybe one day he will. Let me instead concentrate on the book that he did write, which is largely an analytical account of the constraints that the RBI faced in addressing the bad debt problem. And he focuses heavily on the budgetary difficulties of the government and emphasizes how a tight fiscal situation inhibited the ability of the government to address the bad debt problem, partly because of the direct budgetary costs and partly because banking is always a tempting source of cheap finance for governments. I have 3 questions for Viral. First, you say in the preface that when you got to India in 2017, the whole process of trying to fix the bad debt problem seemed to be on track. You mentioned that privatization was even being mooted. 10 months later in the process, 10 months in, the process seems to stall and actually goes into reverse gear. I would love to know what happened. What is the backstory behind the apparent backsliding by the government? Did it suddenly realize that it was just going to be expensive and balk at the price? Or why has privatization always been taken off the table? I would have thought that, without sort of analyzing it very carefully, that the budgetary costs of privatization would actually make it an attractive option. I think, as I said earlier, I think a alternative explanation is that politically powerful industrial families use their clout to lobby against the reform. And I would love to get your views about this. Secondly, much of the book, as is appropriate, is forward-looking. It's about how to fix the problem of this gigantic overhang of bad debt. But if you widen your perspective and ask the question, how did we get here in the first place? I mean, in my experience, all financial crises that I've ever studied, there is a lot of blame to go around. I mean, crises tend to be like those Agatha Christie thrillers, where there's so many potential culprits to blame that your head spins. So, for example, in India, there are some who would put the blame on a moribund public sector banking system, especially venal public sector bank chiefs. Others would point their finger at corrupt business practices and poor governance of Indian business houses. Still others would have blamed the inadequacy of the RBI as a regulator. Others point to their finger at the political meddling by politicians in the lending of public sector banks. In your opinion, which of two or three of these are the root causes behind this silent financial crisis, as you call it? And I have a further question, which is, what is going to change going forward? Even if the government, by magic, had the resources to recapitalize the banking system and put it on an even keel, would the same old problems that have dogged the Indian financial system for the last couple of decades just resurface? I mean, speaking personally, and this is probably something of a prejudice, I think the fundamental problem is the dominance of public sector banks. I mean, I know of no public sector banking system that has been successful. It seems to me that it's not a coincidence that three of the countries with the highest ratio of problem loans are Brazil, Russia, and India, all of which have banking systems dominated by state banks. My final question is, where does this all end? As things stand today, given the magnitude of the economic contraction after COVID, it looks as if the authorities missed a crucial window for dealing with the bad debt overhang. Now, the problem is now only going to get worse, a lot worse. I mean, I've seen projections that suggest bad debts are going to rise by another 30%. And even before the downturn, there were signs that because public sector banks were in trouble, most additional lending had been done by private sector banks, and they were now facing bad debt problems of their own. So is there a limit to how bad it can get? I mean, I like to go back to your analogy of the rubber band. I mean, you could argue, for example, in the US, the limit was reached when we got that massive run on the system, and the authorities had no choice but to take immediate and drastic action. So my question to you is, how close are we to that limit? Thank you.
Thank you so much, then. Rakesh, I see you chomping at the bit. Please.
Thank you very much, James, and thank you, Ajay, for inviting me to be on this Zoom seminar. Viral, also for really having written this book. He was my successor 3 times removed. I'm that old. So it's very seldom, I think, Actually, he and Governor Urjit Patel have written books after their tenures that are quite different from all their predecessors, because many of us have actually written books after. One of the occupational hazards of being a governor or deputy governor is that you give lots of speeches. And therefore, when you retire, you have a great opportunity to put them together in books. So I actually did two of them, but neither of them as brilliant, of course, as Viral's. But from what you read in the book, from what Viral described this morning in his presentation, and then Liakat's own comments, it seems to be a very different country. It seems to be a very different Reserve Bank of India, a very different financial system than what I left in 2009. Obviously, everything went to the dogs after I left the Reserve Bank of India. But more seriously, it is very interesting, actually. I'm making this point in a more serious way that clearly Viral's book reflects his experience in the Reserve Bank in 2017 to 19, and the outcome of the various problems that had arisen in the previous 5 years or thereabouts before he got them. And so, in some sense, it was the outcomes of problems that the country experienced around 2010 to 14 or 15, including very high inflation, which was probably a consequence of the excessive fiscal and monetary expansion after what I always call the North Atlantic financial crisis. Unfortunately, our government in 2008-9 pretended that it was also Indian financial crisis, but it wasn't. And we did the absolutely excessive fiscal and monetary expansion 2009, 2008, 9, 2009, 10 onwards. Second, that the whole issue of non-performing assets, the NPAs, the stressed assets, bad loans, etc. Many people, including Liaquat, just mentioned that this was a consequence of the very high growth of credit in the previous decade. I've been trying to look at that data very carefully, actually. And even though I'm not yet satisfied with the quality of data that I've looked at, but what I do find is that most of the debts that went bad actually were given after 2009. That's not just because I left in 2009, but purely factually, that most of the debts that went bad were actually the loans were issued after 2000, most of them after 2000. I'm not saying obviously none before, but most of them, more than 80-90% of them, were actually issued after 2009. And the big feature of this actually is that most of these non-performing assets were due to large private corporate sector. Very few, apart from Air India, I think, in the large Indian public sector borrowers. So it's a very curious thing that happened. I would say somewhere between 2010 and 2009-10 until around 2013 or thereabouts, where this huge lending took place to the large corporate sector, large Indian corporate sector. The big growth in credit in the previous decade is actually in retail lending. Housing was all new in India at that time. Housing, consumer durables, etc. And the growth rate, of course, was indeed higher in that period. And corrected around 30% a year thereabouts for 6-7 years. And most of it was retail lending. Corporate borrowing was not that great in volume. And of course, the total credit started from a low base. So even though in terms of growth rate, the credit growth was indeed much higher in the previous decade, in terms of magnitude, it was much, much higher in the following decade, in the following 5 years, actually. Went, as I said, around 2009 to 14 or there, something of that order. So among the things that took place at that time was that the government started an infrastructure program focusing much more on public-private partnerships. And of course, in some sense, there's a reasonably there's a lot of international experience on what happens in public-private partnerships. And I think that many of the NPAs will do that. But of course, in some of the sectors that were also mentioned, like steel, textiles, and others, which are not really public-private partnerships, so you need to sort of separate out the bad debts that grew in that period from one that were perhaps government behest, or possibly infrastructure lending, some other large sectors, but also some sectors that just went bad internationally, that is steel and things like that. So it's I think that there's still more research to be done on what really caused this problem. That's the first point. Second, that one of the very curious things that has happened, to my mind, which is behind the fiscal dominance that Viral has documented so well and analyzed, that there's a sudden steep drop in financial savings, household financial savings in the country after 2010 or thereabouts. And I've been trying to look at this very carefully, but I just cannot get an understanding of how and why this has happened. Because in the previous decade, one of the key features of the very high growth rate that India experienced in the previous decade, reaching around 9% in 2003 to 8 or thereabouts, just under 8.9% or so. One of the key features was a very high increase in both household financial savings and corporate savings. And therefore, the net household financial savings would actually finance both the government and the corporate sector quite comfortably in that period. And so there's basically a drop of from around 10% of GDP household net financial savings, that is net of their liabilities, net financial savings from around 10% of GDP to around 7% in the years following ever since. And with the fiscal dominance comes in because with the overall government borrowing, government deficits, both central and state governments combined, being roughly similar magnitude, that basically the government is eating up all the household financial savings, and so you have a real problem. The second very interesting issue on the fiscal stress is another feature that I find a real puzzle is that the Indian tax GDP ratio has not increased for 30 years, since 1990 or thereabouts. I'm talking very broad terms, of course, it's gone up and down a bit. And today, of course, is actually a tax GDP ratio, a peak was in 2007-8, and today, of course, is lower than what it was 10 years ago. So my point there is that with something like 6.5% to 7% annual growth, around say 6.5 for 30 years since 1990, it is bizarre that the tax GDP ratio has not gone up, while in some sense, really very high quality tax reforms that were done through this whole period, resetting the income tax system, the corporate taxes, the customs duties, and domestic indirect taxes over different stages of this whole period. So the point I'm making is that the fiscal dominance issue that has arisen in the last 10 years, and Viral is absolutely right in focusing on that. To my mind, there's two key components. One, that the tax GDP ratio has not risen. Is it because of bad tax reforms? Is it because of corruption in tax collection, compliance, etc.? Because you would have thought that as the number of people in the taxable category has absolutely exploded compared to what it was 30 years ago. Similarly, corporate profits, etc., that this just is very, very difficult to understand. And as a consequence, you're getting this problem that on the one hand, as an economy grows, the government's responsibilities grow in different spheres. Therefore, it needs more and more resources. If the tax GDP ratio doesn't grow, then of course it has to borrow. And there you come with fiscal dominance. And then on top of that, of course, for other reasons that you have the NPAs rising, then that compounds the problem that Viral has so expertly described, analyzed in his book. So there is indeed because of the fall in household financial savings, there's a huge crowding out of the private sector, and also therefore higher real interest rates. what is also interesting to me in terms of the public sector bank domination and also the sort of government RBI interaction, government public sector bank interaction. What is also interesting to me is that we actually have, from the time the reform started in 1991 until around 2008, I would the book that I wrote after I left the Reserve Bank, it was published in 2011. The title was almost the opposite of Viral. That is, the title of my book was "Growth with Financial Stability: Central Banking in an Emerging Market." And what I extolled was the great financial stability that we had and how well we had done, etc. And I think behind that was that there was less interference in banks, as I observed. Essentially, I can even say firsthand that since I was Secretary Economic Affairs in the Ministry of Finance, in charge of banking for just under a year, in terms of the appointment of bank CEOs, public sector bank CEOs, I can now say that I was in charge of that. So every time that we had to appoint a bank chairman, we had a process from which names that came up. I would go to the then finance minister and say, "Look, who do you want?" And I have to say that in my just under a year of experience in the ministry in 2004-05, not once did he give an opinion. He said, "This is your job, not mine." So it was very interesting to me that over a period of time, just under 20 years, that the government, it seems to me, had self-disciplined, and you can also see that in the performance of the public sector banking system. So by around 2008, in most metrics of efficiency, public sector banks had improved tremendously the previous 10 years, and they were not very far off from the new private sector banks. And so the question that really arises is, I think the question I'm raising is that, that what was different then? What changed after that? Why have we come to the path that we have, which I'm not disputing? So I'm not sure how much more time I have. Okay. So let me just, I could go on for another 20 minutes, but I'll end with a few questions for Viral, just as Liaquat did. One, on privatization. The issue to my mind has been not that there is an issue, of course, the political economy of privatization, but also the practicality in terms of availability of private capital in the country. And that is illustrated by the three largest so-called Indian private sector banks all have between 60 and 74% foreign equity. So what's the practicality of actually privatizing the bank, a significant amount of Indian banks? Second, that you and I, Viral, do agree greatly on RBI independence. I'm not so convinced on juridical independence, in the sense that we've had some examples where juridical independence was granted initially when the Telecom Regulatory Authority of India was appointed. But then when the government wanted to fire the chief, which actually the law prohibited, they did. And the chairman who was fired, despite having been a high court judge, did not protest. And then the law was changed. Third, one question on the regulation and supervision, that just as we have formed the MPC, I have some reservations on that, but I won't go into that right now. But in terms that, just like the Bank of England, why can we not also turn the Board for Financial Supervision, which does exist in the Reserve Bank, into a more independent entity like the MPC is? And finally, the bad bank, that especially now in the context of COVID, things are going to get much worse. The same kind of issues have arisen as they arose in 2009-10, 8-9. Regulatory forbearance, more fiscal dominance, dilution of the IBC, and so on. Now, of course, debt moratoriums. And from what I've read, I think 80% of individual borrowers have taken advantage of debt moratorium. 80% of small and medium enterprises have done so, and almost 60% of the corporates. So how is this all going to play out? And the last question that the Yakat raised: how will we get out of this? What's going to happen?
Thank you so much, Rakesh and Yakat. Clearly, we have a short time and a number of questions to respond to. I'll make the decision to go over by 10. In the meanwhile, those of you in the audience, please put down some questions in the Q&A WebEx notation there. And I'll turn it back to our speaker to respond to the discussants. Take 3 or 4 minutes to answer these questions.
Yes, thank you. Thank you, Liaquat and Rakesh, for these really terrific discussions. I think they really get to the core of the chapter. And let me see if I can do justice to the questions in a short amount of time. I tend to agree with Liaquat that, a financial crisis is really caused by something that looks like a perfect thriller along the way. And I made a deliberate choice to not pose it as a thriller and not actually sort of do an attribution piece by piece of along the chain. And this has been my approach all along. Even when I looked at the global financial crisis in the United States, there are many accounts which are very rich in their details about how everything broke in the chain in the end. But to me, it all comes down at the end as to who is going to bear the cost in the end of the excessive credit underwriting and its poor quality. And why is it that that party is actually not doing the right due diligence? And I wrote a book was mentioned, and my sense was that crisis in the United States was also very complex. Clearly, the private sector in 2002 to 6 played a very, very important role. In the end, the United States housing sector was a ticking time bomb, in my view, because of the subprime forays that had become very large on the balance sheets of Fannie, Freddie. And, ultimately, the guarantees they were providing had put the housing sector on an unsustainable path. So I think I've followed a somewhat similar approach in keeping with the consistency of their style, which is that my preference has been to go after sort of what I could assess as sort of the big elephant in the room. And to me, that big elephant in the room I fully agree. I think the presence of the public sector banks for the banking sector problems is key, because I think that's where the buck stops in the end. Like one party that's providing the finance, the representative of the taxpayer, is not actually asking the hard questions in the end. And you raise the right issue of why not. But I think what I was trying to convey in the chapter in the book is that my experience of it, I could have focused on just the banking sector issues, but my experience of it was that the pressures were actually far pervasive. They cut into bond market regulations, they cut into external sector regulations, they were about pressure on the central bank's own balance sheet. And that gave me a sense that while there are banking sector specific issues, the deeper malaise in the system is actually that the government is going on a limb on its fiscal programs. And let me try to combine this with Rakesh's point, which is that my sense is that the turning point is the global financial crisis. Because the global growth has slowed down since then. The global stimulation that you used to get through a combined China and US and European growth is now no longer able to take other countries along. And as a result, every country like India now has to generate substantial growth on its own. Now, you can do this in a 1990s style where a country says, no, I'm going to embrace serious structural reforms and unlock growth. But instead, what has happened is that the pressures have been such that and the choices made have been such that the reliance has been on short-term growth measures. I think debt-fueled stimulus, which of course Raghuram Rajan's book Fault Lines argues that that was a choice that the US politicians made in order to counter their growth pressures because of the growth of China. And I think in a way, India has taken on the same path where short-term growth pressures are being met through a credit-based stimulus. And therefore, I think that the broader fiscal dominance view may be more crucial. Just a couple of last points. I think my starting point was very interesting because if I think about the history of the Federal Reserve, and economist Julio Rotemberg has this view that essentially a lot of good that the Federal Reserve has done has come about because of retribution in response to past crises. So, after the Great Depression, a lot of strong financial stability regulations got put in place. Then they were weaned off, unfortunately, starting in 70s over a period of 3-4 decades. Then we had the global financial crisis. And once again, we had a huge round of retribution from the Federal Reserve in strengthening the pillars of financial stability in the last 10 years. I thought that the period of 2015 onwards in India was a period of retribution from the Reserve Bank of India. But unfortunately, that period was not allowed to reach its natural completion with definitive financial stability reforms. And I think, to me, the reason why this has not been allowed is because the government is still focused on pump priming the economy through its own balance sheet. And now, of course, public sector balance sheets are an important part of that. But I think in India, there are many other programs which are actually causing the fiscal excesses and which are actually creating this whole wave of pressures throughout the system. But last point, how is this going to play out? It's hard to guess. There are two possible scenarios in my view. One is that the reversal that has happened since the global financial crisis. India was a centralized country, then it started liberalizing and decentralizing. My assessment is that post-global financial crisis, it has gradually moved back to being more centralized in its approach to the economy. I worry that COVID could lead to a response which is actually more inward-looking, more centralized. And if that happens, I anticipate India to become a lower productivity, a lower growth, more repressed economy as a whole. That is definitely one fork on which I'm attaching a higher probability going forward. Another probability is that it doesn't go down that path, but the fiscal situation becomes a little difficult to deal with. Either the country reacts to this proactively, which is what many of us are trying to push for, like we need a set of fiscal institutional reforms now besides financial stability reforms, or it waits for the doomsday, so to speak, and then the scenario takes place. Now, how does the fiscal scenario play out? Will it be will it be sort of a double-digit inflation episode again? Is it something that is more sinister than that? I think, there are several different paths there. But I would put a high probability on both a low productivity, centralized economy, or sort of a scenario in which a fiscal let's call it a fiscal stress causes either a proactive response or perhaps leads to some difficult situation in the first place. Last point, maybe if James will just allow me 1 minute. I do think that in the end, while there are problems in the private sector, while there is corruption, while there are compromised bankers, my assessment is that if the central bank is allowed to hold its line in its operational autonomy, it can either fix problems along the way or guard against them, or even if it hasn't been able to do so, it would be able to go through this phase of retribution, where having learned from a past crisis, it puts in place a series of measures for the next 20, 30 years so that similar mistakes don't happen again. And this is why I really play up the role of an independent central bank, not just in the letter of the law, but operationally, as a very important institution in a country that can actually prevent private excesses, government excesses from actually taking the system in the wrong direction. And to me, the real issue in the table is that why is it that in spite of public acknowledgement of all these problems, Liaquat, as you mentioned, all of these issues are now out there. And yet we are not seeing a consensus towards actually making the central bank more at arm's length. And I fear that this is because of a movement back towards more of a centralized economy. In fact, Dr. Reddy, I'll end with his quote from the chapter from his foreword in the book, which is truly masterful. He says that in 70s and 80s, the government, the central bank, and the public sector banks, we operated like a Hindu undivided family, where no one kept anyone's proper accounts. My fear is that we should not end up in that sort of a situation again. And so I want to come back to the issue of central bank's autonomy as being a possible check and balance in the system to prevent that sort of a situation from happening, because then you will have no gatekeeper, so to speak, and we could end up again in the 70s and 80s kind of a growth rate. Let me stop there.
Great. Thank you so much. I will take the two questions that I see up top, and we'll finish off today's event if you're answering them. First question: the theory of inflation targeting explicitly requires the fiscal to be under control. Was flexible inflation targeting premature, or the triumph of hope over experience? Second question, that was from Suman Berry. Second question from Ritu Basu. The problem at hand, described as risks to financial stability, rent-seeking behavior, and low-level productivity trap due to fiscal dominance. Could it shift? Should there be some opening up for foreign residents to be allowed to hold government bonds? Those are your two questions. Thank you.
Yes, thank you. Thank you for these questions. Yeah, one view of flexible inflation targeting is that if the prerequisites are not met, such as a stable fiscal situation, it's better to do away with it. My view, and I felt it on ground when I was there, having been part of the Monetary Policy Committee, is that flexible inflation targeting framework, for all its limitations, as Rakesh was also alluding, was actually an operationally autonomous, independent institution that has succeeded in putting some reins on the government's excesses. As I note in the preface chapter, the excesses were not allowed to reach the levels of the post-GFC level. And I give some credit to the flexible inflation targeting framework, more to the institution, more to the fact that it is allowed to run as an operationally autonomous committee of people. I give it credit in not allowing the fiscal to get even worse than what it has. So I would persevere with it. I think if prerequisites are not right, if financial stability and fiscal stability are important prerequisites for it to succeed, I would focus on repairing them institutionally going forward and give flexible inflation targeting another run, because 4 years is too short a life for an institution to leave a lasting legacy and impact in building the credibility of the inflation targeting by the central bank. Second point, I have always been for calibrated opening up of the Indian economy. Coming to this goes a little bit to Rakesh's point. I'm not so bothered that private banks are owned by foreign capital. In most of the cases, it's not like a very concentrated stake. It's a fairly dispersed stake owned by the foreigners. And to me, there is no other way out, given that the fiscal is dissaving all the savings of the economy. I think we need capital to come from outside if we have to allow the private sector to grow. As I said, my concern is that we might see a period of repression, not just in India, maybe in other countries as well. And having a calibrated opening where the external fragility risks are factored in would be the right way to go. The usual prescription there from the Rangarajan Reddy report of the 90s is that foreign direct investment, equity investments are the preferred capital flows first because they are not as fickle and fragile as the bond market flows. Then you get into private sector borrowing space, and the last would be the government bonds, and in the very last would be a dollar-denominated government bond because that has the worst properties as far as an external sector downward spiral goes. But I've always been for calibrated opening. In fact, I have a speech in the book on viable capital markets, and I explain there that we try to follow a principle-based approach to open up and yet keep the external sector stable at the same time.
Well, great thanks to everyone on the panel today. Thanks to the audience and to the IIEP team behind the scenes. We will see you next time on Envisioning India.